one do. So given the low number, I think I take a high proportion of them. I've been to a bank, visited a physical bank. Okay, fine. So I asked this question for a reason, and I'll tell you. Now, second question, my second or something that I want to know from you guys is, if I tell you, I'll give you 1,000 rupees, okay? Will you keep it under your bed or will you deposit in a bank? I need some energy.
Bank.
Huh? I'm giving you 1,000 rupees, so tell me. Deposit in the bank. So you keep it. Huh? Okay. So, definitely will not keep it at your bed, right? You will be keeping it in the bank because the bank will be paying you some interest, right? For keeping the money over there. That's basically the logic, right? Assuming that you will not spend it. Fine. So before I start, I'll just play a small video, okay? Just a small video about evolution of bank, okay? And I'll touch upon few topics because Karthik and Abhishek said they're wrapping up in 10 minutes. So I'll just play a small video. Can I play this one? I think there's no sound. Go out of the slide mode, I think.
The team at Bank S is worried. Despite their CRM and loyalty programs, customer analytics and mobile apps, and a flood of offers for their cardholders, they have had less and less impact on customers. Bank S wants card members to select their card as the first choice for every purchase, to increase spends and engage better with high-value customers, such as Anna. On her frequent business or social trips, and in daily life, Anna wants to get the best value whether shopping, dining, catching a local event, or buying holiday gifts for her family. Anna has 5 different cards in her pocket. She receives hundreds of deals, with overwhelming options and irrelevant offers. Anna is frustrated. How can Bank S simplify her choices and make offers more relevant so that Anna reaches for their card more often? Can they do it? Yes, with Maya, Crayon's unique personal choice guide. Maya combines taste, influence, behavior, and context to offer the most relevant and personalized options at the right time to people like Anna. How does Maya do this? Maya is built on Crayon's Simpler Choices platform, which ingests huge amounts of taste, influence, and context data, and maps them into a proprietary cross-category taste graph. Let's take dining. We start with a single restaurant. Some people like this restaurant. One of them likes many others as well. One of these is liked by others. And in this way, our graph connects every restaurant in the world to every other one, and builds affinities between each of them. We do the same for 9 other categories like shopping, deals, events, and link the category graphs by using explicit individual permissions. We remove all personal information to create a very big, anonymized cross-category taste graph. How do we make this work for Bank S? First, we take the anonymized data within Bank S on individuals like Anna and link that back to our wider taste graph to create a personal taste fabric for each customer. This allows us to generate a wide list of choices. Crayon's choice algorithm then prioritizes these by location, day of the week, weather, or any other context where a customer like Anna exercises choice. These ultra-personalized choices can now be offered to Anna on any channel or device Bank S chooses. Bank S can now make Anna special offers at her favorite retailer or family diner, suggest the best sushi restaurant to take clients to when she travels, the best shows to catch, or gadgets for her kids. Anna now reaches for her S card every single time, because they just seem to know what she wants. With Crayon's Maya, Bank S now has a competitive edge over other banks with higher activation rates, cross-category and cross-border spends, and, most of all, more revenues and better customer engagement. Maya transforms the misery of choosing into the magic of choice. That is how Crayon is simplifying the world's choices.
Okay, so we saw that like this particular bank. How many of you understood the video? I mean, some people can raise your hand who have not understood or didn't follow it much. So I'll give a little background of banking. Alright. So the first banking transaction that happened was in 11th century. Somebody in London gave some amount of money to a person to buy a house. That was the first credit that happened. And with that came the evolution of banking industry. So that is how banking started, fine. But now what we are seeing that in banks, there are a lot of things that the banks are under a lot of pressure. One of the pressure is, I asked you guys this question that I give you 1,000 rupees, where will you keep it? You will keep it under your bed or you go deposit in your bank? The logical answer was, I'll keep it in the bank because I'm getting some interest rate. Now, a lot of these banks, they are actually not making money out of the traditional business. A lot of, in the major economies like US, Japan, etc., we are actually seeing what is something called the negative interest rate. So if I tell you that you give me your 1,000 rupees, I'll give you 900 rupees back, will you keep it with me? No, right? Obvious answer. So there is a regime of negative interest rate that is happening. So the banks are not really making any money by just lending and keeping deposits, right? So if they are not really making money, then they have to make profits for their shareholders or for anyone, right? Now, how can they do that? One way of doing is cutting down operational cost. What is the operational cost? I also asked another question that how many of you guys actually been to a bank, right? Now, if my biggest operational cost in any business is resources, human resources, right? I have to maintain 100 branches. I have to maintain 100 branch, 100 locations, etc. What if I digitalize everything? What if my entire banking experience is through internet, through mobile, through some other device? I don't have any of the bank branches because nobody actually goes to the branches. Because when I asked how many of you been to a bank, I think hardly, there were like 2 or 3 people who have actually been to a bank. So in the recent industry trend is that the people actually prefer, they don't like going to branches or to any bank to actually do their business. So to do that, there has to be an all-round digitization of bank, right? Now, if I'm doing an all-round digitization of bank, then I need to know certain things. I'm dealing with high volumes of data. I'm dealing with choices. A lot of this particular example, this Maya or whatever this product that they have displayed, it is giving you a lot of choices, right? There are so many banks. So to give you choices, personalized choices, you need to know certain things, right? Your demographic data, what is your taste, etc. Your transaction data, what is the kind of transaction that you have done with the bank in the past. This kind of things that are molded into so that it's built into a product wherein you don't just get a loan from the bank, but also you get a lot of value-added services. That is how the banks are going to compete. So if you move to the next. Yeah, there is a small example. All of you have been to an ATM, right? Everybody knows what is an ATM. Now, how do you think banks decide on how much cash to keep in a particular ATM? In your PSG Tech, right in the front gate, there are 2 banks, right? 2 ATMs are there. Now, how does a bank decide how much cash you need to keep in those ATMs? You cannot. Is it a good idea to keep a lot of cash? Is it a good idea? It's not, right? And it's also not a good idea that if there are two banks, Bank A and Bank B, they have an ATM side by side, right? If Bank A runs out of money, so Bank B is making money out of that, right? So the runouts are also not good, is a good thing for the banks. So how do banks optimize this? So this is a very simple case. It's basically you have your past, your past data, which you can, put it into a optimization engine through a SAS algorithm or any kind of algorithm. This is just a high-level stuff that is given over here. Actually, a lot of things goes into it. Things like your location. Is the ATM located in a mall, or is it located in front of a PSG tech? Or let's say, if it is located outside a petrol pump or which side of the road, right? So what kind of information you are getting? You are getting geospatial information, type of customer. If it's in front of PSG tech, mostly students will be using. It will be low volume transactions. If I put it in front of a mall, so there can be some high value transactions. So the amount of money, the number of denomination of bills, etc. will matter. So these kind of information are kind of fed into this particular algorithm for the banks to come up with the optimum number of cash they keep in each of the ATM. Now they also have to channelize the cash has to physically go and replenish this ATM. So how do you optimize your transport network? So your transport, let's say you have a limited number of trucks to go and replenish your ATM. Which one will you go first? Where will you go first? If I take this particular example, PSG Tech, there are two ATMs side by side, right? Let's say 2 kilometers down the road I have a single ATM. So logically, it makes sense for me to replenish this ATM first, because if I run out of money, then I'll be losing out business to the other bank. Transaction cost and everything I'm losing out. So these are very simple questions and simple business decisions which are taken. And when you look at it at enterprise level, right? So you're dealing with data, you're dealing with the business understanding, you're dealing with logic, etc. to come up with a package or an algorithm which tells you at the same time how to allocate your resources at what geographies and how much cash. Another thing is that you cannot keep too much of cash in a particular ATM, because if you're keeping too much of cash in a particular ATM, you're losing. There's an opportunity cost, right, of keeping too much of cash in a particular ATM. Nobody's taking out money from there, so you're again losing money, right? So this is a very simple case. Now, another way banks use analytics or data science is, there was a discussion, like Devangana mentioned that in our country, that a person who needs 2,000 rupees goes to a bank and he doesn't get a loan. I mean, sorry to say, this is not a phenomenon in our country. This is what capitalism is. So you need to prove that you don't need a loan, then you will get a loan, right? That is how it works, right? So how does a bank decide whom to give a loan? So when you enter a bank, let's say, how many of you have taken a student loan or any kind of loan, faculty or loan, personal loan, some loan, right? So when you enter a bank, the bank manager they ask you a certain number of questions, right? What is the amount of money that the loan amount, your income, your marital status, your geography where you are staying, etc., etc. So what does he do with that information? He feeds into an algorithm. He feeds into an algorithm and he comes up with your two things that are decided: your ability to pay and your willingness to pay. So your willingness to pay can be framed as whether you are going to probability of default, whether you are going to default on a loan or not. If I give you a loan, if a bank gives a loan to a person, whether the person will be able to pay back or not is decided by an algorithm. And the very biggest example is CIBIL score. How many of you know what is a CIBIL score? FICO score? No? Okay. Go check this out. What is a CIBIL score? Each and every Indian is supposed to have a CIBIL score at a plus 18 age. By 2020, all of them are supposed to have a CIBIL score, at least in urban population. So find out what is a CIBIL score. Now, these are the things that are like, very operational part of the bank, like, keeping money in the ATMs or, what offers to give which particular person. The other very big aspect of banking is, in 2008-2009, when the recession happened, all the industries went down. Every industry went down, right? So, over here, if you think of it, nothing functions in an economy without your banking, right? If you don't have money to, lend or do any kind of business that you want to set up, you need some money. If your banks fail, then your entire economy goes down, right? Now, how do you make sure that the bank doesn't fail? So for that, you have certain things called regulations, okay? So if you can go to the next slide, please. So there is an entire regulatory framework. So for colleges, so what is a regulatory framework? So how many of you know what is AICT? AICT, right? That regulating colleges and all, that what can you teach, what can you not teach. Within certain regulation you have to operate. So banks also have a regulation. Banks also have a regulation. Banks cannot gamble with money, right? After all, it's your money that is being deposited in the banks and that is being lended. They cannot lend it to others or gamble with that money. So there are very strict regulations that are there in banking industry. There are things like Basel, there are things like CCAR, stress testing, etc. And these are little bit geographic specific. So in US markets you have certain regulation, in Indian market you have certain regulation, in European market you have like SCAP, etc. So what is this? What is the purpose of this regulation? The purpose of this regulation is to stop banks from failing. Banks are just too big to fail, right? If banks fail, like if I take an example, if a bank fails, the entire economy fails, right? So I'll give a small example. In Indonesia, if you land in Bali airport, how much it cost from the airport to a hotel in the city, suburb city, any idea? It cost 3 million rupees, 3 million Indian rupees. Shocking? 3 million Indian rupees? You know how much that is worth Indian rupees? How much is worth Indian rupees? Tell me. Any guesses? It's close to 6,000 rupees in Indian currency. So, the logical question is that why is it so that it's costing 3 million over there and 6,000 over here, right? So there must be something fundamentally wrong with the Indonesian economy. So there were bank fails. There were banks that failed, and because of which this kind of imbalances, inflation, etc. happens. So I'm sure even if we all talk about going out and reading about more stuff which you can find out. But the idea, the reason I'm saying so is that certain economies doesn't have a regulated banking structure, okay? And now it's very fundamental that all the banks have to come up with a regulation. It has to adhere under certain regulation. Now, if we have to adhere under certain regulation, then we have to decide, be very specific, whom to give a loan and whom to not give a loan, right? Anyone, how many of you want to have a Mercedes-Benz? How many of you want to have? I mean, come on now. Mercedes-Benz everybody wants to have, right? Raise your hand. Right? How many of you? I see more girls raising hands, the guys doesn't like girls. What do you guys like? Scooter? Come on, man. Lamborghini? What? Yeah, tell me. Lamborghini, Ferrari, what do you want? Okay, so right now, do you have money to buy that right now? So let's say I'll tell you that I'll give you money to buy it. I'll loan some amount to buy a Lamborghini. Am I doing the right thing? No, right? Because you don't have that ability to pay right now. Even if you have the willingness to pay, you cannot pay, right? So that's the thing. So I cannot gamble with others' money. It's as simple as that. So that's the whole reason, right? Banks cannot be, they have to be regulated. They need to know whom they can pay money. So how can you decide on, decide on certain factors or certain algorithms, how can you decide that whom to actually give money? So for those reasons, there are various kinds of modeling that is being done in banks. So when I say a model is nothing but an equation, right? Straight line equation, y is equal to mx plus c. How many of you know a straight line equation, y is equal to mx plus c? Everyone, right? So when I talk of a model, think of a model as like an equation, right? So it's just a simple equation, and if I tell you, using this equation, identify a person who is not going to default on their loans, who is going to pay back your money. Can it do it? No? It can. Trust me, it can. And banking is the very, like one of the I think it was the most evolved industry in terms of their usage of data science and analytics. Banks have been using analytics when analytics itself was not a term, or data science itself was not a term. Banks has been using this algorithms or models or fancy terms that have been come up, data science and etc. They have been using it since the 70s. Since 70s they are using. Fairy Isaac was the first company to come up with a simple logic that if you swipe a credit card of more than $10,000, you will get a call. That is also data. The underwriter in the bank is seeing your application and he is learning from his experience whom to give a loan or not to give a loan. That is also data. It's just now that we are replacing the underwriter with an algorithm. We are training an algorithm to do the work of an underwriter to cut what? Operational cost. That's why we don't need branches. I can do it, you can just go online, put some information, tell the algorithm that okay, these are my information, and the bank will decide therein, over the net, whether you are supposed to get a loan or not. Now, see in the bigger picture. On one hand, you have a regulation which tells you that whether you are supposed to give a loan to somebody or not. On the other hand, you have to cut operational cost. So, in between what? To pacify both of this comes data science. Can I fit an algorithm instead of a branch full of 10 people, which can cater to internet can cater to anybody, right? So the reach is broadened. I don't need 10 people to sit there in a branch catering to only very limited amount of people to underwrite their loans. So my reach is increasing, my sales is increasing. Yet I'm not incurring cost because an algorithm is smart enough to tell me whether I should pay or not. And I'm also adhering to regulations. I'm also adhering to government rules that okay, I will be not reckless with whom I give money. So this is how banking regulation is evolved. This is how banks have, they have how the underwriters are kind of, taken over by algorithms now. And you'd be surprised, some of these algorithms use the same methodology that is being used in health, in pharmaceutical industry, or be it insurance industry, be it research, etc. It's the same thing. So now, where does this banking activities and data science they come up? So I think we have talked about this topic a lot. We all understand what this is. You need a domain expert, you need mathematics, you need computer science, statistical thing, you need data knowledge, etc. So it's basically an overlapping area which requires all of it. So over here, if I think of a bank perspective, I need a guy with the regulation knowledge as well, right? Different geographies, different regulation, etc. That knowledge is also required. So yeah, so it's pretty simple. I mean, I think we have talked upon this topic a lot. So I'll not spend too much time over here. And basically, all this is getting summed up in a banking activity, which I just talked about. So it's basically your regulation, your operational cost, the digitization of banks. In the example, the video that we saw, banks are not just offering you money; it is offering you choices. So when you buy, let's say you go to a mall and you buy jeans, okay? We don't really buy jeans. You buy a brand of jeans, right? Either Lee, Levi's, or whatever, Tommy Hilfiger, right? You buy a brand of jeans. Why do you buy a brand of jeans? Did you ask yourself this question ever? Because brand is something you relate to. It's like, okay, fine, I wear Wrangler jeans, maybe I chose cowboy instinct in me, right? Some kind of thoughts that's going in your head. Simple is the same concept banks are using it as well. So banking is an industry which was immune to disruption for a long time. From 11th century, first loan was given, and if you till today, the banking industry has been very, very resilient of disruption. Very resilient. until now. Until now, because there is a concept of fintech, financial technology, that is revolutionizing the banking industry. You must have heard of this Paytm, right? Paytm is disrupting banking system like anything right now. They must be coming to your placement, hiring some of you guys, but how many of you actually understand what Paytm does? What does Paytm do? Huh?
Mobile wallet.
What is a mobile wallet? Why do you need to pay through a wallet and not through cash or credit card or something? So tell me, what if tomorrow Paytm comes for your placement and asks you, do you know what we do? So will they be happy with this answer? Will they be happy with the silence? They're not, right? Right. So find out. Have that inquisitive bend of mind. See what is happening. Don't restrict yourself by calling yourself techies. Okay? Don't restrict yourself. Find out about industry. Find out about what is happening. Alright? See what is happening in because you'll be surprised how many engineers or how many computer science people they actually work in banks. You'll be surprised. Like you guys are surprised seeing an economics person standing here and giving talk about data science. I get surprised every time I walk into a bank. There are lots of engineers, it's full of engineers. So find out, have that inquisitive bent of mind. Don't restrict yourself by thinking that just 5 years of data science, if I understand computing, statistics and etc., that is going to make you a data scientist. Data scientist is not restrictive. You have to have domain knowledge, certain, right? So that's fine. I think that's pretty much I wanted to cover, and I'm done within my 15 minutes of timeline. So thank you, Nadan sir, thanks, Mark.